In this video, we will see how I would invest $500,000 in the stock market in 2025 if I want to invest in the long term and beat the index, the S&P 500, over the long term. If you have $500,000 in your portfolio, you don't want to go too much speculative. You want to invest in quality assets and you want to sleep well at night. This is the goal of investing, right? We don't want much anxiety. We want to invest in winning companies that will outperform. So in this video, I will give you some tips, some key points to tell you how I would do it so you can copy this for your own portfolio. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now with a performance of 25% per year. And I see a lot of my clients having this portfolio size, $500,000, maybe a little bit more than this. And the key things for this kind of size of a portfolio is portfolio allocation. What is the percentage of stocks you could have in your portfolio, and the quality of your filters. That's very important. And I see many people doing this first mistake of not doing what they, not making any sense of a portfolio, not knowing what they know, what is inside their circle of competence or not. So here are a few bullet points for you. First thing, you have to understand what is inside your circle of competence and what is outside your circle of competence. In the stock market, you have 50,000 companies, 50,000 stocks. So it's very easy to get distracted and see a YouTube video or a Twitter post and say, oh, why not this and why not this? Ask yourself, is it inside my circle of competence? Can I really understand this? Okay, this is the step one. Step two is avoid key sectors that will bring you too much anxiety, that are not worth it at all. So sectors with poor fundamentals or overvaluation. There are some sectors, including the energy sector, for example, that are cyclical. You will fall into many traps if you invest in cyclical industries. This is not for everybody. This is not for all retail investors, especially if you watching this video already have a job. If you have children, if you don't have a lot of time, it will cost you a lot to invest in companies with poor fundamentals that are cyclical. You have to monitor them like a child. You will have many setbacks. It's way easier, much more simple to invest in quality companies with growing industries, okay? So avoid the sectors with poor fundamentals. And the reverse of this would be only focus on growing industries, okay, like cybersecurity or tech, for example, and avoid sectors with overvaluation. There are sectors, pockets in this market with very speculative hype, with a lot of overvaluation and not a proven track record. What you want to fill your portfolio with, if you have $500,000 and you are a serious investor, you want to focus on quality companies that have a long track record, a long history of being profitable and growing and rewarding shareholders. If you fill your portfolio with these golden opportunities, you can outperform the market. If you buy them at a reasonable valuation, you can outperform the market. And if you don't know how to do this, I have a coaching program. This is the first link in my description. You can book a free strategic call with me to discuss if this is a good fit for you. If you have any problems, any issues with your portfolio, if you don't know how to analyze businesses, I have a coaching program that will help you become a better investor. So if you're curious, just click on the link and we can book a free call to discuss, you and me. The call is completely free. You have literally nothing to lose to book a call. The second point I want to talk about is the focus points. What I would focus on. I would focus on quality businesses with pricing power and high ROIC. And I said inflation. Okay, now we are living in a world, globalized world, with inflation and higher interest rates, right? It would be a mistake to have too much cash in your portfolio because the cash will be eaten by inflation every couple of points every year. So you can invest in bonds in the short term, but the main way to not lose money from inflation is to be invested in companies, stocks that have pricing power, that can increase their prices to match inflation, the inflation rate, or even higher. For example, you can have Starbucks that can increase their prices more than the inflation rate. You can have another company called Fair Isaac that delivers the FICO scores that is enjoying very good pricing power, more than 10% per year, more than 20% per year, much more than the inflation rate. So if you fill your portfolio with companies with extremely good pricing power that has the ability to increase their prices every year, like Ferrari, for example, 10% every year, you will beat inflation. And these companies are better positioned in an inflationary environment. Second thing, I talked about interest rates. So interest rates in the US are 4 or 5%. You will have to repay the debt that you have on your balance sheet. Companies that are borrowing right now will have to pay interest rates circa 4, 5, 6%. Okay. Maybe a good way to outperform the market would be to only focus on companies with minimum leverage or no leverage at all, no debt at all, because having higher interest rates will be a cost. You will have to pay interest every month, every year. It will be a cost, a drag on your net income, less profits because you have a cost, right? You have an interest rate, interest expense that will put a cost on everything for the long term. It will reduce your net income. And in the very long term, stock prices follow earnings per share. So you want to invest in companies that are increasing their earnings per share by 10% per year, 15% per year, 20% per year. I fill my own portfolio with companies with these characteristics, companies that can increase their earnings per share by at least 15% per year. And this is the simple reason I outperformed the index and generated 25% per year. It's a screening process. Don't hesitate to be a harsh grader. So 1, stay inside your circle of competence. 2, invest in growing industries. 3, invest in growing companies with pricing power that will beat inflation and that are very efficient. And I said something, high ROIC. ROIC stands from return on invested capital. For every dollar that you reinvest in the business, how many cents do you have? If you reinvest $1 and you can get in 1 year, you can get 50 cents, that's a ROIC of 50%. Congrats. Not a lot of businesses can have a ROIC of 50% for a sustained period. My goal is to teach you, to give you all the tools to find these golden opportunities. This is what we work on my coaching program. You have pricing power, high ROIC, so high reinvestment rate. And if companies can reinvest their profits for 10 years in a row, 20 years in a row, they will outperform because they will crush competition. And this is what we want. We want to invest in winning companies that will crush their competitors. We don't want a company that is having difficulties in the competitive environment. No. We want to find monopolies, duopolies, things that are way better than competition, things that grow more than the rest, that will have their stock price grow more than the rest. This is how we outperform. We don't want to invest in losing companies, right? We don't want to invest in losers. We want to invest in winning companies that will outperform. Third point, the allocation in your portfolio. What is the amount of stocks that is better for you? If you have $500,000, you have a good size of a portfolio to have roughly 10% for each position. You can run a 10 by 10 portfolio. The allocation I would use is 10 to 15 stocks, no more than 10% per position. You want some concentration, but not that much. Because you know what? If you are a retail investor, you have a job, you have children, you don't have a lot of time. So you don't have the time to monitor 50 companies in your portfolio. Okay? Because having a stock in your portfolio is something you have to monitor. You have to read the transcripts, do the work first, analyze companies, follow the story, read the press releases, listen to the earnings calls. You don't want to blindly invest in companies, right? We want to monitor if the thesis is still intact for the very long term, if things are accelerating, what is the potential competition that is coming to eat your lunch. You want to monitor your investments, okay? You want to be concentrated, put all your eggs in one basket and monitor this basket. This is a quote from Mark Twain, I believe. So you want to monitor this basket of highly qualitative companies. Okay, so I would say 10 or 15 stocks is fine. At the moment, I have maybe 12 or 13 stocks. So I do this for my own portfolio, 13 stocks, and I follow this good concentration, because a few months ago, one client joined our coaching program, and he had 60 positions. And he told me, it's impossible to follow everything. I don't follow this. And every time you encounter a new business, he added this to his portfolio. This is his due diligence. The result was very simple. He underperformed, was not happy with his performance. He didn't know much about each company in his portfolio. And we worked on his portfolio, we rebranded everything, we removed all the bad positions, and we only kept the best of the best positions. And now he has a concentrated portfolio of companies he really understands inside his circle of competence, companies with pricing power, high ROAC, reasonable valuation. And since then, he has outperformed so far. It's only the beginning, and I'm forecasting great future for this client. You can do the same thing if you follow these simple steps. Don't be the victim of FOMO, fear of missing out. You don't want to miss out on the next golden opportunities with AI, data centers, or anything like this. You want to focus on winners, right? Companies with a proven track record and a concentrated portfolio. Because even with a portfolio of 10 stocks, you will have to monitor 10 companies, but you will also have to spend some time looking at other companies, things on your watch list, for example. So it's already a lot to monitor 10 companies plus watch list. If you have 50 or 70 companies in your portfolio, that will be too much. You will have an attention span that will be diluted, and you will not know what you own. This is a perfect way to underperform, to not know what you invest in. This is not the goal. You want to outperform, right? This is why you clicked on this video. You want to build a powerful portfolio that will create good alpha, that will beat the index, that will make you wealthy in the very long term. You don't want to have a get-rich-quick scheme. This is not the goal of this YouTube channel. I will give you all the tools to beat the market. Next point. ETFs. Yeah, what about some diversification into an index, into the S&P 500 or MSCI World? ETFs might hurt long-term returns because now the S&P 500 is trading at a relatively high valuation. Yes, we are at a P ratio, as I'm recording this video, of roughly 30 P ratio. If you look at the PE ratio of the index right now, S&P 500, we are trading at 30. Relatively speaking, it's expensive. So relatively speaking, you will not have great returns if you invest in the S&P 500 right now. So instead of investing in the S&P 500, what I would do if I had $500,000 portfolio, just a fresh portfolio, I would totally avoid the S&P 500 and focus on companies that are trading at a cheaper valuation. Companies with a PE ratio lower than 30, and companies that are growing better than all average, better than the average 7%, 8% from the S&P 500. So you increase your risk reward, you increase the attractiveness of the opportunities if you focus on quality companies trading at a cheaper valuation than the S&P 500. But I would totally avoid investing in the S&P 500 right now. The valuation is extremely high. You can check the past 20 years, 50 years of returns. If you had invested at such a high valuation, you would have a very bad performance. You can check for yourself. I'm sure you will have plenty of videos that will tell you this on YouTube that will backtest these results. Feel free to do so, to watch other videos. It will be a mistake right now to have the majority of your portfolio in ETFs when you have the potential to do some good stock picking. Good stock picking will help you. Last point for you, how I would find great stocks in a market that looks expensive. You have small pockets of undervalued stocks. Similarly, in this market right now, you have pockets that are overvalued by a lot of hype, right? But you also have pockets that are overlooked, complete undervaluation. You can look at the home building industry right now, some components in the home building industry. You can look at coal companies that are boring and nobody wants to touch them. You can look at broad opportunities in Japan and Korea. I own a Korean company in my portfolio because the opportunity is quite attractive. The risk reward is very, very appealing, and the valuation is much cheaper than US counterparts. So you can look at everywhere, every country, every industry, but please focus on things inside your circle of competence. Growing industries, growing companies, reasonable valuation, high efficiency, high ROIC, and a concentrated portfolio. This is how you can outperform the market. And now you know what to do, but it will be a little bit harder to implement by yourself. If you want me to personally help you, I have a coaching program. This is the link in the description. You can book a free strategic call with me so we can assess your situation, see if we can work together. And if we can work together, I would be very happy to help you completely rebrand your portfolio, improve your analytical skills, how to spot winning ideas, how to spot the traps so you can avoid falling into the traps, avoid making many mistakes, because mistakes are as important as winning, as having a winning portfolio. If you minimize the numbers of mistakes, you increase the odds of outperforming. In this stock market thing, you don't need to be a genius, right? You just need to avoid as many mistakes as possible. I had a client a few months ago that had a stock in mind, and we worked on this stock together. He was willing to buy it, and we highlighted several red flags. And the conclusion of the call was, I was tempted, but now, Christophe, as we worked on it together, I will not buy it. You know what? I will just sidestep the investment. There are red flags. Guess what? A few days after our call, the stock dropped 70%. It's a mistake my client avoided. What is the amount of dollars this client would have lost if he had fallen into this trap? Not knowing how to see the red flag will cost you thousands and thousands and tens of thousands, depending on the size of your portfolio, but thousands and thousands of dollars. If you don't know how to spot red flags, if you invest in losing industries, in losing businesses, if you invest in losers, you will have a loser's performance. You will have a bad performance if you don't know how to spot these red flags. The goal of this coaching program is to give you all the tools to increase your analytical skills, spot good opportunities, create the portfolio of your dream, and outperform the market. So if you want me to personally help you with personal guidance, you can book a free call. It's completely free. There is the first link in my description to book a free strategy call, and I will see you on the other side.